Good morning, everyone. I'm Martha Stokes. I'm a retired buy-side institution chartered market technician, and I like to share ideas with you that you do not hear on the regular retail news and everything. There is the great divide between the retail side and the professional side, but it is no longer Main Street versus Wall Street. One thing we want to talk about today is risk control and risk analysis, herd mentality, and how you can avoid getting trapped into a herd mentality that increases your risk. It Humans feel safe in a crowd, but oftentimes being in a crowd is about the least safe place you can be, especially in the stock market, because we have about 14 market participant groups now. I've had to increase that and alter my market participant group analysis and cycle theory that I have, because everything is constantly changing. Especially right now, we have a ton of new technologies on things that are changing the markets and how we trade the markets. And it's important for you to understand that by the time you wait for somebody to give you a recommended stock, or the group decides on, in an open chat, decides on a stock that everybody's going to buy, or whatever you're doing, you're putting yourself up for high risk. Not necessarily loss, but very high risk. Today, there's all kinds of things in the news. We're going to be talking using CTSH for this tutorial. It is a tutorial. It is not about what this stock is going to do. This is a common pattern. I simply chose this stock one. It's on the NASDAQ 100 still, because NASDAQ just went through a massive change and continuing change of how they're going to handle the NASDAQ 100 rather than the NASDAQ composite, which is all of the NASDAQ listed stocks. This is going to change the structure of the NASDAQ 100, and that's something that you need to know and understand. If you want me to talk about that in another tutorial, just let me know. We have a company that got late into the AI technology. Now it's going to do a big chase, run up, follow up to catch up. It is doing a pretty good job. It is a company that's been around for a very long time. It is not a new technology. It was started in 1998, and it has been going sideways for quite a while, basically between about 60 and about $70, and then it started coming down this year because it was reinventing, it was purchasing all kinds of different things, it was doing all kinds of changes to its internal structure to get ready to come back and really feature some AI technology in the way that it sees it is useful. And there's a lot of top stories about Cognizant right now and all this stuff. What we have is a fundamental buy zone. This is the fundamental buy zone. They had an earnings report recently, and the earnings have improved, but it still went down because everybody thought, oh, well, we'll sell on the bounce up. And so some more traders sold. This indicator is a very powerful indicator right here. And this shows that this is the final low where it is going to reverse. It is very important not to assume that a stock is going to continue to go down, but also to analyze the internal structure of the candlesticks. We have a nudge here. They're slowing it down. These are where the fundamentals are, and it's dropped and gapped down a little bit on HFT action before the market opens. Then it has a little pop up, and then a run down and a run down and more of a run down and run down. Well, most of this, which is going on, is buy-side institutions of going, fundamentals are way up here, and this stock is down here. So this is a bargain. So we're going to buy this. It currently has 98, almost 99% institutional ownership. So the institutions own the majority of the outstanding shares of the stock, and it's doing buybacks. So we'll have some buyback runs. So we're going to have some swing style runs because there's going to be pro traders nudges and moving this up, more traders nudges that we're going to hit this fundamental zone. And the dark pools will make an assessment, the buy-side institutions will make an assessment at that point as to whether they're going to go on or not. When you're trading, you need to try to get in with these nudges, and you need to try to understand that this is going to be somewhat of a resistance level that may shift the stock sideways into a platform position trade, which is holding for a longer period of time before it moves up. It's got some resistance here and some resistance here that it has to prove and pull up. The dark pools will continue to accumulate in this area on the lower level, typically, if they're in a heavy accumulation, and it appears to be so because they are buying pretty heavily right now. So this is an opportunity for swing trading. It's an opportunity when you see this chart, this stock. I'm not recommending this stock. I'm not telling you to buy this stock. I'm telling you that you need to look for these chart patterns because I'm seeing hundreds of them everywhere. You need to calculate how far it can run. You need to calculate where resistance levels are going to be, where the buy-side institutions are going to continue to buy or stop and let the stock move up with a lot of speculation. There's a lot going on with the stock, and so it's in the news, and it's going to have some speculative activity. How the market opens doesn't tell you how the market's going to work all day long. We had a gap up, and then we had a sink back, and then we have some whipsaw action going through the day. There are many stocks in this pattern. This is a common pattern. This is why I chose it. You have to understand the indicators that are telling you, okay, this stock is not likely to be an ideal sell short because it has finally found its lowest bottom, and there is bargain hunting in this, even though it continues down. Now, why would the dark pools buy a stock that's moving down? Because they're long-term investors and they're not worried about a few dollars variance because they know that the fundamental levels are up here. So they're going to continue to buy and continue to move that price up in tiny little increments. Mostly pro traders find the stock, and that's what you should do. You should look at the pro traders, see where they're at, and move before. If you continue to rely on news and chat room groups and things like that, you will be late in the stock. If you can learn to read the candlestick charts with spatial pattern recognition skills and relational analysis, like I'm doing right now, I'm saying, okay, where are the dark pools? Where are they going to go? When are they going to stop? How far are they going to move? We know that they use very tiny, very, very tight price action. So they're not going to ever produce a really big, huge candle unless the stock is way, way below its fundamental values due to a flash crash. And those still will happen. There'll be some sudden shock, a Rooney, and then we'll have another little pop up and things like that going on. Risk, controlling your risk isn't about getting in front of the mirror and telling yourself you're confident. Risk is being confident because you are capable and you are making consistent profits over time with very small losses. You can have to control your risk because if you do not control your risk and understand who is in control of price, which market participant groups are, where are they, speculative and this type of thing, you will always be lacking a certain level of self-confidence. You will get into a stock because everyone else is getting into it rather than seeing that it is right for you. Another reason I chose this stock is it's not very expensive. A lot of stocks are around $1,000, $3,000 right now, and that's just way too expensive for a lot of people with their smaller capital bases. You must trade the capital base, the size. You must trade the price range that you are comfortable and capable of trading with your capital base and your risk tolerance and your experience. You must know where the pro traders are going to get out. You must know where the pro traders' nudges are likely to be. You need to understand how volume relates to the different market participant groups because when the dark pools are accumulating, volume will often be slightly below their activity. This sagged down, but they were slowly buying in and stopping that. This is a common pattern right now. That's why I chose it. So you have a lot of opportunities with a lot of stocks that are coming out of bottoms right now that you could trade. And it's a very good way, especially if they have buybacks, because the buybacks are intended to push the price up. So there's buyback runs. You just need to know how to get into the buyback run before it starts. You need to think, I'm not going to get into the stock because I see an engulfing wide, or I see a springboard pattern, or I see another morning star, or whatever. I'm going to get into the stock before those things move because I have to get in sooner and earlier than you are doing right now to net more profit. We're in a penny spread market and it's very, very tight action. And if you spend your time moving with the herd mentality, you're going to be picked off because everybody else sees your orders. Your brokers have to light your orders before they are sent to the payment for order flow market makers. And the market makers fill your order and they make lots of money because they are able to nudge up a penny price or whatever, and they have huge volumes going through. So you have to understand the market is very different. And I want you to strive to start learning to be ahead of everyone by being with the pro traders and being aware of what buy-side institutional activity looks like. It's going down and they are buying. And that's something that is I'm seeing in many, many charts. This is just one example. I'm up with my time for the day. Thank you for joining me. I appreciate all of your comments. And if you have anything you want me to discuss, I'll be happy to do so. Trade wisely rather than emotionally. I'm Martha Stokes, and that's the topic for today.